last time I changed an asset allocation in my own personal portfolio was 2024 when I switched Solana for Sui.
Mm-hmm.
And then I'd done any other trade since then. I've added risk or added money into the trades, but no, I barely trade. The other side of the equation is I've spent a lot of money allocating to digital art.
Raoul Pal compares Bitcoin's current phase to Google's in 2017, highlighting the importance of early adoption and powerful network effects. He likens Bitcoin to Google in its early stages. Both Bitcoin and Ethereum are still in the initial adoption phase. Network effects are key drivers of cryptocurrency value. In a recent analysis, macroeconomic investor Raoul Pal expressed his optimism about the future of Bitcoin and Ethereum, comparing their current situation to Google's in 2017. According to him, Bitcoin is still in its early stages, far from saturated, and its value is primarily due to the growing power of network effects. Just as Google had not yet reached full maturity in 2017, but had already transformed our relationship with information, Bitcoin is redefining our understanding of money and digital ownership. But its growth potential remains significant. Paul's analogy reminds us that investors may still be at the beginning of the adoption curve, despite the increasing number of institutions and individuals entering the world of cryptocurrencies. Network effects refer to the phenomenon whereby a product or service gains value as its use becomes more widespread. Paul points out that Bitcoin and Ethereum are benefiting from this in real time. As more developers contribute to these networks and the number of users who own or interact with cryptocurrencies increases, the value of the ecosystem grows. According to Raoul Pal, trade less, just buy, and hold key coins like Sui, Solana. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
So on the macro side, the business cycle, which is the main kind of driver of everything, has been very subdued for this entire cycle. And that's been driven by the high rates environment and the liquidity environment. If you, on a forward-looking basis, understanding all of the fiscal stimulus that's coming, plus liquidity stimulus that's coming, and the probability of rate cuts coming, the chances are the business cycle is going to be a lot stronger going into the election year. Don't forget, we've got Scott Bessent running the Treasury. He's an ex-hedge fund manager. He understands this game very well. So how do you value, at the simplest level, how do you value a network? It's the number of active users and the total value transacted per user. So that's the way you can normalize every network down to that. And when you do so, it actually makes sense of all the valuations of the chains. It's actually really interesting. There's a few outliers within it. Things like Cardano will be an outlier because there's very little economic activity on the chain, but there's quite a lot of holders, but they're not super active. But generally speaking, sort the networks by that, it works perfectly. So once you understand that, you know what grows the network. It's adding actual real active users that are persistent over time and the amount of economic activity. So if you think of a system like Ethereum, you also count the layer twos because the layer twos are activity built on the same network. And so once you start looking at this, you understand Ethereum's value. So the question is with Ethereum is, will more value be transacted on Ethereum in 3 years' time, 2 years' time? Probability is yes, because of the financial system, stable coins, and all of the things we're seeing.
Paul predicts Bitcoin could reach $250,000 thanks to increased global liquidity. He believes the prevailing pessimism is fueling the next major growth phase. Altcoins could experience explosive gains as liquidity cycles expand. Paul believes a major expansion phase has begun. He encourages investors to focus on global liquidity rather than short-term fears. He considers liquidity the engine of every strong market rally. His data shows that liquidity explains most of the movements in Bitcoin and the Nasdaq. When money becomes more accessible, prices tend to rise faster than expected. Recent figures confirm his analysis. Bitcoin rose 13.1% last month, reaching $94,388. Paul predicts a peak between $250,000 and $450,000 during this cycle. He also sees significant opportunities for altcoins. He anticipates returns similar to the spectacular surge in 2017. His view is based on long-term trends, not fleeting hype. Bitcoin has generated an average annual return of 130% since 2012. This growth occurred despite sharp corrections that led many investors to withdraw from the market. Paul believes that fear drives future rallies. When most investors are hesitant about the market, high volatility typically ensues. He argues that the current situation fits this pattern. Paul observes a global shift toward greater liquidity. Weak economic growth and rising debt are prompting central banks to adopt more expansionary monetary policies. These cycles typically fuel sharp rallies in major assets. He warns investors about silent threats. Inflation and currency depreciation reduce the value of a portfolio by approximately 11% annually. Paul categorically refutes warnings about a tech or cryptocurrency bubble. He argues that we are staying within normal trend limits. According to him, price to earnings, PE, analyses overlook the influence of cryptocurrency depreciation on prices. He also points out that Bitcoin follows its trend lines without reaching extreme highs. He connects all of this to global liquidity and debt cycles. His analysis presents current prices not as irrational, but as determined by precise mechanisms. Paul asserts that we cannot speak of a bubble in the markets as long as tech and cryptocurrency stocks remain within one standard deviation of their long-term trend. He argues that the discourse surrounding speculative valuations ignores how weakening fiat currencies cause prices to rise faster than earnings. He argues that if the currency depreciates by 11% while the real economy grows by 2%, the PE ratio will double in approximately 8 years. He considers this denominator effect a key factor in rising prices. Furthermore, he highlights Bitcoin's position relative to the trend. Therefore, according to Paul, current cryptocurrency price levels are not the result of excessive speculation. They are mechanically linked to currency devaluation and the mismatch between income and inflation. The cryptocurrency industry faces a harsh reality regarding its valuation. Across various blockchain networks, users are selling for between $2,500 and $23,000 each, far exceeding the $400 to $500 per user valuation on Meta. This gap persists despite the absence in the cryptocurrency sector of genuine loyalty programs, monetization mechanisms, and network effects that would justify such premiums. This discrepancy raises crucial questions. Do current blockchain valuations reflect true economic fundamentals or simply speculative optimism? Paul directly compared cryptocurrencies to Google, Amazon, Meta, and Tesla using Metcalfe's law. He suggested that Bitcoin resembled Google in 2017 in terms of its development trajectory. According to him, cash flow analysis fails to capture the essence of digital asset valuation. Paul's position emphasizes future potential and network growth trajectories. This perspective values crypto assets based on anticipated adoption curves and future market dominance. This approach assumes that current usage patterns will evolve as the infrastructure matures and widespread adoption accelerates.